Um, Once again, good afternoon. Before we officially start with the presentation, allow me to reiterate our few house rules. All participants are muted by default to provide clarity to the audio of our speakers. You may also send your questions anytime during the webinar while our speakers are discussing through the Q&A box located at the bottom of your Zoom screen. And all questions will be catered during Q&A session after the presentation of all our speakers. Today, we will be joined by the following speakers. She is a corporate and litigation lawyer who has been a member of the Integrated Bar of the Philippines since 2016. Prior to joining Carpo Law Associates, she was a junior associate at Suarez and Nervasa law firm, where she gained extensive experience in representing various clients before different first-level and appellate courts and government agencies in the Philippines. She handles contract drafting and review, corporate acquisition, corporate due diligence, company incorporation, intellectual property, registration, and litigation. She also drafts legal opinion and legal memoranda. She is likewise proficient in handling civil and criminal litigation, labor disputes, and family law. Attorney Veron obtained her Bachelor of Laws degree from Simbera University College of Law in 2015 and was among the top 30 of her graduating batch. Prior thereto, she obtained her undergraduate degree of Bachelor of Science in Commerce, major in Legal Management from De La Salle University, Manila in 2009. For our next speaker, he is a corporate and tax lawyer who has been a member of the Integrated Bar of the Philippines since 2020. Prior to joining CLA, he was a senior associate at one of the leading audit firms in the Philippines. While working for the audit firm, he handled tax audits and tax compliance cases and represented multinational and domestic clients before the BAR. He is experienced in the areas of registration and formulation of business entities, corporate restructuring, and mergers and acquisitions. He is also knowledgeable with other forms of corporate reorganizations. Attorney Kim obtained his Juris Doctor degree from the De La Salle University College of Law in 2019. He completed his internship program with the Public Attorney's Office as a legal aid intern, where he assisted fellow lawyers in handling criminal, civil, and labor cases. Prior thereto, he obtained his undergraduate degree in political science, as also from the De La Salle University, Manila in 2013. Thank you so much for expressing your interest in today's webinar. Before we dig into today's discussions, allow me to introduce myself. My name is Alexis and I am the Digital Marketing and Event Specialist of Kittelson Carpo Consulting. KNC is a one-stop shop business consulting firm catering to both local and foreign clients doing business in the Philippines. We are a subsidiary company of Incorp Global, who is a leading corporate solutions provider in Asia with regional offices in Singapore, Hong Kong, India, Indonesia, Malaysia, Philippines, and Vietnam. Our services vary from business registration, product registration. We also cater to tax incentives, visas, payroll, HR consulting, recruitment, and legal compliances. Recently, our team was joined by our newest business development manager, and for purposes of client relations and to allow you further to connect with us, I'd like to call on Kareem for a quick introduction.
Good afternoon, audience. I hope you guys are well and keeping away from COVID-19. So my name is Kirim, and I'm the new business development of Kittelson Carpo. I'm pretty excited to help any kind of entity or corporation. I'm here to listen any problems or growth achievements that you have. Nice to meet you all. Hope we will coordinate more in the future.
All right, so thanks a lot, Kareem. To continue in providing quality services, KNC works with its affiliate firms such as AHC Certified Public Accountants for accounting and bookkeeping services. We also partner with KC Global Talent Solutions for recruitment and executive search, and of course, Carpo Law Associates for all the legal inquiries. With that, please welcome our first speaker, Attorney Veronica Alon-Gloria.
Good afternoon, everyone. Is my audio clear?
Yes, Attorney, you've been clear.
Okay. All right. Good afternoon. I'm Veronica Alon-Gloria, and I will be discussing today the different types of alternative work arrangements, which are sanctioned by our laws and the issuances of the Department of Labor and Employment. Accordingly, in times of economic difficulties and national emergencies, just like what is happening at present due to the COVID-19 pandemic, our government recognizes the need to adopt alternative work arrangements to prevent outright termination of the services of employee and total closure of establishments. In today's webinar, we will be focusing on the guidelines in the implementation of these alternative work arrangements. Next slide, please. Okay. Before discussing the different types of alternative work arrangements, we will discuss first the objectives of these alternative work arrangements. So the first one is job preservation. As previously mentioned, with the current restrictions, especially in the health and safety and decreased economic activity, businesses are trying to survive and maintain their operations. One way to survive and to conserve its resources is to cut down its costs, and more often than not, at the forefront thereof is the labor cost. As such, the issuances on the alternative work arrangements were promulgated to recognize and encourage the adoption of these alternative work arrangements to alleviate the impact of unemployment and to preserve jobs. Next is to lower the cost. In connection with the objective of preserving jobs, the adoption of alternative work arrangements is a way to minimize operating costs and reduce work-related expenses of employers. The next one is to minimize job disruption. In times of economic difficulty and national emergencies, businesses will need to find a way to continue their operations, and the adoption of alternative work arrangements is a highly effective tool in minimizing job disruption, thus promoting productivity and efficiency. The next one is to keep the talent. As we all know, the existence of economic difficulty and national emergency is not permanent. So during and after that economic difficulty and national emergency, the businesses will have to maintain their competitive edge. One of the benefits of alternative work arrangement is to keep the talents of employees with sufficient experience and skills. Aside from that, it also promotes employees' need for a balanced work life. Next slide, please. So we will proceed with the legal basis of the alternative work arrangements. It is worthy to note that the guidelines on the alternative work arrangements are already existing prior the pandemic. So the basis for the alternative work arrangements are as follows. The first one is the labor code, and then in implementing rules and regulations thereof, and the Department Advisory Number 02 Series of 2004, which talks about the compressed work week, and the Department Advisory Number 02 Series of 2009, which explains the flexible work arrangement, Department Advisory Number 04 Series of 2010, which discusses the implementation of the flexible work week arrangement rather. And just recently, a few years back, our legislators enacted officially the Telecommuting Act by virtue of Republic Act 11165, and it's implementing rules and regulations covered by Department Advisory 202 Series of 2019. And in connection or pertinent to the pandemic that is happening currently, the Department of Labor and Employment issued Labor Advisory Number 17 Series of 2020, which expounds the Telecommuting Act more. So now we go to the features of the alternative work arrangements. So these are the matters that are common among the alternative work arrangements. The first one is that the alternative work arrangement must be agreed upon by the employer and the employee. So it is a voluntary agreement, and it may be indicated in the company policy or in the collective bargaining agreement if the company has a union. The next one is that the labor standards are still operative. So the provisions on the hours of work, the overtime pay, the uh, leave benefits are not suspended. So they're still inoperative during the implementation of the alternative work arrangement. The next one is just like in the labor standards, the occupational safety and health guidelines are not suspended. Next, fair treatment. So workers working under the alternative work arrangement must be given the same treatment as that of comparable to the employees working at the employer's premises. So there must be no discrimination between the employees under alternative work arrangement and those employees who are working at the traditional workplace of the employer. So the next one is that there must be a prior notice to the employees within reasonable time. Being an arrangement which is voluntary in nature, of course, the employees must know when will the arrangement will start. The next one is there must be a DOLE notification requirement. So as will be discussed later on, there are reportorial requirements that must be submitted to the DOLE before the implementation of the alternative work arrangements. So as previously mentioned, the alternative work arrangement is just temporary. So it will be indicated in the establishment form that will be discussed later on, the period within which the alternative work arrangement shall be valid or shall be implemented. And next, in case of disagreement, so the dispute may be referred to the existing grievance machinery, which is existing in the company policy, or in case there is none, it may be referred to conciliation or mediation in the DOLE regional office or field office. So it is senable, so to speak. It can be a subject of single entry approach. So we go to the different types of alternative work arrangements. The first one is the compressed work week. So this is covered by Department Advisory number 02, series of 2004. So as we all know, the normal work hours is 8 hours each day for 5 to 6 days a week, as the case may be, because some of the firms require 6 days, and it's perfectly valid. And equivalent, the work hours is equivalent to 40 or 48 hours. So in the compressed work week, what will happen if this is implemented? There will be more than 8 work hours, but not more than 12 hours. But the 40 and 40 work hours per week shall be retained. And the employee shall be still entitled to meal period not less than 60 minutes. So the effect thereof is that there will be a reduced work day, but the work hours per week, which is the 40 or 48 hours per week, shall be retained. So simply stated, there will be an increased work hour per day, but decreased work week. But it is important to note that the employees may work beyond 12 hours, but the hours worked beyond the 12 hours shall be subject to overtime pay. Now we go to the coverage of compressed work week. So all establishment may implement the compressed work week. The exception to that is if the employees are working under the construction industry, the health services, or occupations requiring manual labor, and workers exposed to airborne contaminants, carcinogenic substances, chemicals, or noise that exceed threshold limits for an 8-hour workday per the occupational safety and health standards. However, there is an exception to this, such that even if the employees are working under these harmful elements, if the employer will be able to obtain a certification from the health and safety practitioners or organization, or even on this firm's safety committee, that hours worked beyond the a normal 8 hours is within the tolerable levels of exposure stated in the occupational safety and health standards, then the compressed work week may be implemented in these industries. So now we go to the other types of alternative work arrangements, which is also known as flexible work arrangements. The first one is compressed work week, which we already discussed a while ago. And the second one is the reduction of work days. So the reduction of work days refers to one where the normal work days per week are reduced. But this arrangement shall not last for more than 6 months. And during the same, as previously mentioned, there shall be no diminution of pay. So the labor standards, the implementation of labor standards are still intact. The next one is the rotation of workers. So this refers to one where the employees are rotated or alternately provided of work within the work week. So an example list of this is that the implementation of ABC will be working from MWF Monday, Wednesday, Thursday, Friday, while DEF will be working from Tuesday, Thursday, Friday, Saturday. So that's the type of the rotation of work. The next one is the forced leave. So it refers to one where the employees are required to go on a leave for several days or week, utilizing their leave credits. So the important here is that there must be a leave credits existing, or that the employees are still entitled to leave credits. Otherwise, of course, the no work, no pay rule shall be applied. The next one is the broken time schedule. This is a type of alternative work arrangement. So it refers to one where the work schedule is not continuous. For example, employee A will be working from 7 a.m. to 11 a.m. and the next shift will be from 2 p.m. to 8 p.m. So long as the work hours within the day, which is 8 hours, shall remain. And beyond that, of course, he or she will be entitled to overtime pay. The next one is Flexi Holidays. So employees agree to avail the holidays at some other days. So for example, the recently concluded holiday, which is the araw ng Kagitingan last April 9, may be moved to some other day. However, that employee who availed of the Flexi Holiday shall still be entitled to his or her holiday pay. The next one is Flexi Time. It is also known as gliding. It refers to one where the employees are required to complete the work hours in the establishment, but are free to determine their arrival and departure time. And then there are other reasonable alternative work schemes. An example of which is in case there will be a closure of branch, then the transfer of some of employees to that branch. Now we go to the Telecommuting Act. So it is implemented by Republic Act 11165 and Department Advisory number 202 series of 2019. So it is a work arrangement that allows employees in the private sector to work from an alternative workplace. So this means that the employees will be working remotely from the traditional workplace. An example is working from home, working in a co-working space, or anywhere that meets the requirements as stated in the Telecommuting Agreement. So the following are the guidelines in the implementation of the Telecommuting Agreement. The first one is there must be a telecommuting program. So it provides for the set of guidelines and policies for the implementation of telecommuting work arrangement. So this may be included in the collective bargaining agreement, and it may include the following: the eligibility of the employees who will be under these telecommuting program, the applicable code of conduct and performance evaluation and assessment, and the appropriate alternative workplace, the use and cost of equipment, and the work days and or hours. So these are some of the provisions in the telecommuting program. The next one is the telecommuting agreement. So as previously mentioned, an alternative work arrangement is voluntary and it's subject to the mutual agreement of the employer and the employee. It is not a unilateral agreement which the employer may implement on his or on its own. So it's a mutual agreement. It's a voluntary agreement between the employer and the employee. So the telecommuting agreement is the documentation of that consent of the employee rather. So aside from the telecommuting program, the establishment implementing the alternative work arrangement or the telecommuting arrangement must have a telecommuting agreement. So during the telecommuting arrangement, the employees working under the telecommuting under such must be given the same treatment as that of comparable to the employees working at the employer's premises. So as previously mentioned, there must be no discrimination between the employees working under the telecommuting arrangement and from the traditional workplace of the employer. The next one is the provision on the data protection policy. So in the telecommuting program, there must be a provision on the data protection policy because the employer shall be responsible for strictly appropriate measures, strictly taking appropriate measures to ensure the protection of data used and the processing thereof by the telecommuting employee. And for his or her part, the employee shall commit to the company's data privacy policy. So this is in connection with the Data Privacy Act, which is being implemented in every establishment. So last year, because of our COVID-19 public health crisis, the Department of Labor and Employment issued Labor Advisory 17/2020, which is pertinent to our current health crisis and in connection with the Telecommuting Act. So it covers all employees in the private sector operating or allowed to operate to resume business operation under community quarantine. So during the implementation thereof, the employees must still adhere to the minimum health standards. So the salient points of the Telecommuting Act in relation to Labor Advisory 17/2020 is that the employees on work from home telecommuting arrangement shall be provided with adequate support to perform the assigned task or job. As you may have noticed last year, employers provide for the computers or other telecommunication provision to their employees so that the employees will be able to perform their work even they are working remotely. So the next one is there can be an agreement on the adjustment of wages and wage-related benefits. So the employees, the employer and the employees may agree in writing to temporarily adjust the employee's wage and wage-related benefits. However, there are some limitations. The first one is, as previously mentioned, it must be voluntary and it must be in writing. So the adjustment must not be lower than the minimum labor standards. So it cannot be, of course, lower than the minimum wage if in case there will be adjustment. And the adjustment shall not be more than 6 months. All right, as previously mentioned, the establishment who would like to implement the alternative work arrangements are required to submit an establishment form, that is RKS Form 2020, to the DOLE through their website, which is reports.dole.gov.ph. So in case there will be a reversion or there will be a return to work order. So actually this is a management prerogative. Such back to work order shall also be reported to the DOLE. Okay, so what are the key takeaways from this presentation? So the first one is the termination and closure of business is the last resort. That's why our government issued these legislations to cover or encourage the use of alternative work arrangements. The second one is during the implementation of the alternative work arrangements, the labor standards and occupational safety and the health compliance are still operational. They're not suspended and they're still being implemented. The next one is that it is temporary and voluntary in nature. As previously mentioned, there must be a report to the DOLE, and part of that report, there is a statement in connection with the period of the implementation of said alternative work arrangements. So thank you for listening. I hope you learned something new from today's discussion. I know we have a Q&A later, but in case we will not be able to answer them all, you can, we are more than willing to answer those questions, and I will try to answer them immediately. You can just send me an email at veronica@carpolaw.com. Thank you.
Okay, so thank you so much for that very extensive discussion, Attorney Veron. Now we will be moving forward to our next speaker. Let's all welcome Attorney Kim Patrick Darius.
Hello everyone, can you hear me clearly?
We can hear you, Attorney.
Alright. So hi everyone, again, I'm Kim Patrick Darius from Carpo Law Associates. So I am tasked to discuss the legal developments in time of COVID-19 tax edition. So COVID-19's impact, as we all know, extends far and beyond the influence not only the health of the population, but also the performance of corporate enterprises and businesses. Measures from the government to contain COVID-19 have had quite a significant effect on the Philippine economy and the world's economy. Okay na ba yung presentation, Alex? Sorry.
Yes, we can see it now.
All right. So to continue in the pursuit of the government to support distressed corporations and businesses such as SMEs, the government have adopted several tax regulations and to an extent a legislation which would hopefully boost the country's ability to attract lucrative investment opportunities and ultimately to stimulate economic growth and sustenance. Mainly, the government has created a CREATE Bill. The app passage of the CREATE Bill would provide companies and businesses with one of the most sizable economic stimulants in the country's history. So in this webinar, I will discuss the salient points of the law, as, as well as all regulations which might affect your businesses and corporations during this time. So going into my first slide, Corporate Recovery and Tax Incentive for Enterprises Act, or CREATE as we know it. The bill actually amends the tax code on a per tax type basis. And I think it's prudent to discuss it on the same vein, but due to limited time period, I will just discuss and point out the salient points and some of the vetoed items of the president. So just a brief background of the law. It was an initiative actually by the 15th or 16th Congress last March 2018 under the Train 2. So further, it evolved into Trabajo Bill, which actually passed the third reading in September 2018 rather. And then the Senate had not acted on it. And later on, another law in regards to corporate reformation was passed by the Congress, which is Material Bill. It only passed the third reading, but it did not went beyond it. And now, with the advent and the occurrence of COVID-19, the Congress actually acted on creating a bill that would help and guide and actually aid the corporation and businesses during this difficult time. So we can say that the act is a part of the corporate fiscal reforms undertaken by the country since 2018. Just a brief status background on CREATE. It was signed, as we all know, last March 26, 2021, with several line veto items, which I will discuss later, but not all. And under Section 22, it shall take effect within 15 days after it is published with the official gazette or a newspaper of general circulation. And since it was published last March 27, 2021, the effectivity date is April 11, 2021, or 4 days before the annual internal tax revenue deadline for the submission of all the returns. So for my next slide, I will just give you a brief overview or a rundown of the different, the new and updated tax rates. So for domestic corporations, the tax rate was reduced from 30% to 25% effective July 1, 2020. So the effect of the law retroacts to July 1, 2020. The MSIT, or the minimum corporate income tax of domestic corporations, was reduced from 2% to 1% effective July 1, 2020 to June 30, that's actually 2023. So it's for only a limited period of time. For domestic corporations with net taxable income not exceeding 5 million and total assets not exceeding 100 million, the new rate was reduced to 20% or a 10% cut from the original rate of 30%. So for this item, for the computation of the total assets of the corporation, the corporation shall exclude the land on which the particular business entity's office, plant, and equipment are situated. For nonprofit and proprietary educational institutions and hospitals, it was reduced from 10% to a meager 1% rate from July 1, 2020 to June 30, 2023. So it's just a 3-year period. It's a provisional relief given to non-proprietary educational institutions and hospitals, which we know have been heavily impacted by the COVID restrictions. So for resident foreign corporations, same with domestic corporations, the rate was reduced to 25% effective July 1, 2020. So for MCIT of resident foreign corporations, similar with domestic corp, it was also reduced to 1% from 2%, effective also for 3 years from July 1, 2020 to June 30, 2023. For non-resident foreign corporations, it was reduced from 30% to 25% effective January 1, 2021. Now, you ask why the difference of the effectivity between a resident foreign corporation and a non-resident foreign corporation. Well, simply because non-resident foreign corporations are not governed by our accounting and taxation laws. They are governed by the resident states. So basically, we can just tell them to adjust their accounting reporting just because of the change in our corporate tax laws. That's why the BIR have given ample time to non-resident foreign corporations to align their accounting reporting, financial reporting. So for regional operating headquarters, it was actually increased from the preferential rate before of 10% based on their taxable income. Now they will be subjected to a 25% regular corporate income tax, effective also January 1, 2022. So they have actually 2 years to study their financials if they deem it still sufficient to stay in the Philippines or move to another country who offers the tax incentives. For changes on rates on certain passive income, for the first item here in my slide, capital gains tax on capital gains derived by resident foreign corporation on sale of shares of stock not listed or not traded in the stock exchange. So it was increased, they standardized the rate to 15%. Because if you remember, for individual and domestic corporations, the capital gains tax from unlisted shares is already indicated in the train law, and they are already subjected to a 15% final tax. And this provision resulted from the negligence or the oversight of the previous legislators to include resident foreign corporation. So parang hinabol lang or in-insert with this provision yung resident foreign corporation. So as we all know, resident foreign corporations are taxed the same way as a domestic corporation. So for the next one, final withholding tax on interest income from depositary bank under expanded foreign currency deposit system derived from resident foreign corporations. So from 7.5, it was standardized and increased to 15%. All right. Clear ba yung screen ko? Sorry.
Yes, attorney.
All right. So for the next change or development put forth by CREATE is on the intercorporate dividends tax on foreign source dividends derived by domestic corporations. So under the old rate, it was 30% unless covered by a tax treaty. if you remember intercorporate dividends, just a brief background, intercorporate dividends received by a domestic corporation from another domestic corporation is exempt from all taxes because it's merely a flow of capital pursuant to the continuity of investment principle, which we have adopted under several tax jurisdictions, specifically the US. But if the dividend income came from foreign corporation, we usually treat it as subject to regular corporate income tax. But now, the 8th bill actually grants an exemption of foreign source intercorporate dividends, provided the following conditions are met. So I provided here 2 conditions, but the revenue regulations have actually enumerated 3. So just to briefly, the first condition that the company must meet to exempt the foreign source intercorporate dividends from all regular income tax is number 1, the dividends actually received or remitted into the Philippines are reinvested in the business operations of the domestic corporation within the next taxable year from the receipt. So if you receive the intercorporate dividends this year, 2021, you must reinvest into your business operation within the next year. So you have to reinvest the money you received this year in your business operations for next year. Number 2, dividends received shall only be used to fund working capital requirements, capital expenditures, dividend payments, investment in domestic subsidiaries, and infrastructure projects. So the application of the dividends must be limited to these items. Otherwise, your intercorporate dividend sourced abroad will be subject to a regular corporate income tax of 30%. So for the third condition, domestic corporation must hold directly at least 20% in value of the outstanding shares of the foreign corporation and has held the shareholdings uninterruptedly for at least 2 years at the time of the dividend distributions. Now, what if the foreign corporation has only been operating for less than 2 years? Now, the BIR, through their revenue regulations, has clarified the said item by saying that as long as the domestic corporation holds the shares from the foreign company uninterruptedly since its incorporation, then that would fall under this condition. So another provision that is a welcome addition to our tax laws is the repeal of improperly accumulated earnings tax. It's really a welcome development, especially for those who have clients that is family-owned corporation. Because most of the family-owned corporations forgo the issuance of dividends because they wanted to keep their capital within them. So by the repeal of IAET, they can now withhold the issuance of any dividends. And they will not be subjected to some sort of a penalty tax. And another thing, if you remember, if you have not been distributing dividends and you are a closely held corporation, the prima facie evidence of improper accumulation of earnings is when retained earnings is in excess of the 100% paid up capital. So if you reach that threshold, you will be immediately subjected to IAET. So it caused a confusion before because under the tax code, there is already a fixed formula in determining the improperly accumulated earnings of the corporation. And suddenly, thereafter, the BIR came up with their own regulations, completely different from what was written in the tax code. and it actually provides a higher tax base. So for several years, it caused a confusion in the application of IAET. So it's very good on the part of the BIR to have actually repealed this provision. Because personally, from my point of view, distribution of dividends is a matter of right of the stockholders. So for the next provision, deductible interest expense for income tax purposes shall be allowed net of reduction rate at 20% from the previous 33%. So in relation to the reduction in corporate income tax rate, although this is supposed to be on the later provision of the bill, we are connecting the same mainly because this was driven due to the reduction of the regular corporate income tax, which was from 30 to 25 or 20%. So basically, tax arbitrage is a common tax saving device wherein the taxpayer would secure loan to generate interest expense, thereby reducing their taxable income because of the interest expense deduction. And also they will enjoy a tax benefit there too of a they would also incur a benefit of a 20% final withholding tax and a reduction of income tax due to the interest expense deduction. So the BIR, to limit such scheme, they came up with the following provision. The deductible interest expense is reduced only to 20% of the interest income subjected to final withholding tax on the interest income. Because normally the tax arbitrage represents the difference between the corporate income tax and the final tax of interest income. So the idea is that we are able to claim interest expenses which will produce a tax benefit on us based on the corporate income tax rate, but we earn interest income that is subjected only to a lower final withholding tax, which is 20%. Hence, the difference shall be accounted for through a tax arbitrage. So next one is the provision on tax-free exchanges. So under the tax code, no gain or loss shall be recognized if it is in pursuance of a plan of merger or consolidation. So meaning purely equity transaction lang under Section 40C of the tax code. So what CREATE did was just to expand the coverage of merger and consolidation so as to include the acquisition of another company or corporation, even if it's not labeled as an actual merger or consolidation, as long as the acquirer corporation will have full control of the acquiree corporation. It also included recapitalization and reincorporation. Reincorporation meaning when you cease operations for a couple of years, and then you decide to incorporate again under the same business name. Moreover, under the CREATE law, the sale or exchange of property used for business for shares of stocks covered under the tax-free exchanges shall be exempt from value-added tax. Well, this provision is superfluous in my opinion, because it's already covered by the train law previously. But I guess they just wanted to make sure that the BIR officers would really be made aware of the following VAT exemption. Another thing that CREATE introduced is a new paragraph in the provision for tax-free exchanges. Specifically, the provision indicating that you don't need a prior BIR ruling in order to treat the transaction exempt from tax. Well, from previous engagements and by practice of some, and also as observed by the BIR, you have to secure a BIR ruling, which would actually take you around 6 months to a maximum of 2 years at most to obtain the following ruling that you need to exempt the following transaction from any income tax or VAT. However, under Revenue Regulations 5-2021, it is explicitly stated there that you don't have to obtain a BIR ruling before you treat this as a tax exempt transaction. Also, under the same revenue regulations, there's no need to notify the BIR of the same, but it will be subjected to a post-transaction audit. So I'm not just sure how do they apply the following. Do they audit after the following the normal audit procedure, or do they have a different? So it's for us to find out in the following months how would they go about this one. For losses to be carried over for the next 5 years instead of the current 3 years of NOLCO, net operating loss carryover. So what this just means is that the company is allowed to deduct the incurred losses from tax payments for a much longer period, or from the previous period of 3 years. Now they extended it to 5 years. And this one is also pursuant to the provisions of the Bayanihan Act. The next provision, VAT shall not be imposed on tax-free exchanges as previously discussed earlier. And under VAT, another set of VAT exemptions which CREATE has included: number 1, the sale or distribution, importation, printing, or publication of any educational material covered by the UNESCO agreement, including digital and electronic format. Well, they just added journal, and not just on books or printed materials. They also included digital and electronic format. One condition that this VAT exemption must meet is that it shouldn't be principally devoted for advertisement or commercial use to be VAT exempt. So for COVID-related VAT exemptions, all drugs, vaccines, and medical devices prescribed and used for the treatment of COVID-19, capital equipment, its spare parts, and raw materials for the production of personal protective equipment for COVID-19 prevention, drugs for the treatment of COVID-19 approved by the FDA for use in clinical trials, including raw materials directly necessary for the production of such drugs. This was included in the provisions of the law in response to our COVID-19 prevention measures. So if you fall under these 3 items, you will not be subjected to any VAT. For the last VAT exemption, the sale of prescription drugs and medicines for cancer, mental illness, tuberculosis, diabetes, high cholesterol, hypertension, and kidney disease beginning January 1, 2021 instead of January 1, 2023 under the train law. So they just amended or modified the effectivity of the same, because as I mentioned, it was already included under the train law. So from the previous 2023 effectivity, they just made it earlier to this year. And Also, in this provision, they just added illness that might be subjected to VAT exemption. For example, cholesterol and high blood pressure, which was not really present under the train law. So the next one, the reduced percentage tax from 3% to 1% effective July 1, 2020 until July 1, 2023. Well, it's basically a form of an aid, particularly targeted to small medium enterprise whose sales do not actually exceed 3 million pesos. So if you're a small medium enterprise, it's a welcome development to have percentage tax reduced from 3% to 1%. For the next provision, the introduction of general provisions on tax incentives, which include scope and coverage and extent of coverage and authority of the Fiscal Incentives Review Board and or investment promotion agencies. So this is a whole new set of provisions pertaining to tax incentives. Ultimately, the bulk of the amendments would be coming from this one, the rationalization of fiscal incentives. It materially affects the business enterprises on different investment promotion agencies like PEZA and BOI. So what are the tax incentives under the CREATE law? Number one is the income tax holiday, which is already existing as of before CREATE bill was put into law. It was provided by the Omnibus Investment Code. Number two, the special corporate income tax rate of 5% on gross income earned in lieu of all national and local taxes. So it can be likened to our preferential 5% gross income tax under the Special Economic Zone Act. So they just changed the naming. Number three, the enhanced deductions. This is in an entirely new incentives provided by CREATE bill, which I will discuss briefly later. Number four, duty exemption on importation of capital equipment, raw materials, spare parts, or accessories. Number five, VAT exemption on importation and VAT zero rating on local purchase under Section 294 and 296. So the law provides that it must be directly and exclusively used in the registered activity by the registered enterprise to avail of the following VAT exemption. So the tax incentives can actually be grouped into two. Before kasi with the train law or the previous CREATE bill versions or in the CETIRA and Trabaho bill, either you avail of ITH, income tax holiday, then SCIT agad or enhanced deductions agad. It was actually changed by the BICAM committee. Thus, for export enterprise, these options are both available. However, for domestic enterprise, the second option is their option is limited on the second one. So for export, they can either avail of income tax holiday and then a 5% SCIT, or income tax holiday and enhanced deductions. Meanwhile, for domestic market enterprises, they will just be forced to actually choose the latter one, the income tax holiday and enhanced deductions. The income tax holiday and enhanced deductions option for non-critical domestic enterprise with investment capital of less than 500 million is actually vetoed by the president, as well as the critical domestic market enterprise for ITH SCIT is also vetoed by the president. So what are the enhanced deductions under CREATE? First, I'll just go over through the enumeration because it's pretty straightforward and in the interest of time. So for the first one, depreciation allowance of assets acquired for the entity's production of goods and services. So 10% for buildings and 20% for machineries and equipments. 50% additional deduction on labor expense due to increase of direct local employment. 100% additional deduction on the increment of research and development incurred, provided that it is directly related to the registered activity. As I mentioned a while ago, it must be directly and actually used by the registered entity to the registered activity. Next is the 100% additional deduction on trainings incurred given to employees engaged directly in the entity's production. 50% additional deduction on the increment of the domestic input expense, provided that it is directly related to the registered activity. 50% deduction to power expense. 50% deduction for investment from undistributed profit or surplus in any of the project or activities listed in the SIPP within 5 years from their investment, and the enhanced net operating loss carryover, which can be carried from the year it was incurred to 5 years, within the next 5 years. So here's a table for the duration, just an overview. So for domestic market enterprises, they can enjoy an income tax holiday of 4 to 7 years and an enhanced deduction of 5 years. So for SCIT, they cannot avail of the same because it was vetoed by the president. For export market enterprise, they can enjoy 4 to 7 years of income tax holiday and a 10-year applicability of SCIT or enhanced deduction, whatever they choose from the same. So here's an overview again of the availment period. Actually, there are two things that affects the length of the ITH availment. So it depends on firstly, it depends on the tier where your entity is included. So for tier 1, it's basically a high potential for job creation. It generates value creation through innovation and essential support for sectors that are critical to industrial development. For tier 2, it's more on support. They produce supplies, parts and components, and intermediary services not locally produced, but are critical to industrial development and import substituting services. So for tier 3, research and development resulting in significant value added, higher productivity, improved efficiency, and breakthroughs in health and science, generation of new knowledge and intellectual property, commercialization of patents, industrial designs, and many more. So if you belong to any of the tiers, you will have the following availment period. If you are with tier 1 and you are located within the NCR or National Capital Region, you are allowed to enjoy the ITH benefit for 4 years. If you are with tier 2, you'll be allowed to enjoy it for 5 years, and for tier 3, 6 years. But if your business is located in metropolitan areas or contiguous or adjacent to the NCR, for example, if you're located in Laguna or Cavite, and you belong to the Tier 1, you can enjoy the income tax holiday for 5 years. If Tier 2, 6 years, and for Tier 3, 7 years, or the maximum availment period allowed. For all other areas outside Manila, for example, in the province, somewhere in Bataan or Subic, if your business is included in the Tier 1 definition, as I mentioned a while ago, you can enjoy the ITH for 6 years. And if you belong to Tier 2 and Tier 3, you'll be permitted to enjoy it for 7 years maximum period. So note that the 10 years is fixed for export market enterprises. So wherever they are located, they have a maximum fixed period of 10 years to avail the enhanced deductions and SCIT, and 5 years for domestic market enterprise in relation to their enhanced deductions, regardless of the location or tiers. So just a brief discussion on the sunset provisions, or what would happen to those who are currently enjoying these tax benefits. So if your corporation is only granted an ITH or income tax holiday, you have to finish the remaining income tax holiday period. For the sunset provision, if you're currently availing of the 5% gross income tax for 10 years, and you can reapply under the same. So for the vetoed provisions under which the president has vetoed, first one is the inclusion of the 90-day period for the BIR to act on claim for tax refund of general taxes erroneously or illegally paid, or penalties imposed without authority reckoned from complete submission of documents. So this one is different from the 90-day period for the BIR to act on a claim for VAT refund. This one is for general taxes, annual income taxes. So this was vetoed by the president by reason of administrative difficulty in implementing the same. Because if you could remember, under the tax code, the claim for general tax refund requires actually full audit by the BIR of all the books of the company. Excuse me. Hence, the period given by CREATE, which was 90 days, for the BIR to complete the entire refund process or credit process, they will just be left with two options, which number one is to grant the refund, or number two, deny outright without the benefit of a full audit review of all the books of the company. That's why the president vetoed the same. Next one is the special corporate income tax incentives, 5% for activities classified as critical and tier levels. As I discussed earlier, the non-critical domestic enterprise and critical domestic enterprise cannot avail of the 5% SCIT because it was vetoed by the president. And another veto line item is the increase in VAT exempt threshold on sale of residential lot valued at 1.5 million to 2.5 million, while house and lot and other residential dwelling from 2.5 to 4.2 was outright vetoed by the president. Because as the veto message provides, the original intention of this provision is to provide relief to to those to socialized housing buyers and base level economic housing projects. So if they would allow the increase to 4.2 million, it would benefit not the intended beneficiaries, but also the non-targeted beneficiaries of this provision. In effect, it would result to some sort of a tax exemption that is highly distortive of the fiscal adequacy of the government. So that's my presentation for Create Law. We now move to electronic signature on BIR forms and certificate. So we find the legal basis for the usage of electronic signature or on BIR forms and certificate on RMC 29-2021 in relation to RA 11032 or the Ease of Doing Business and Efficient Government Service Delivery Act of 2018. So under the RMC, you can use e-signatures through the following forms or BIR certificates, namely BIR Form 2304, BIR Form 2306, BIR Form 2307, and BIR Form 2316. So per the RMC, the electronic signature appended on such forms and certificates would serve as a functional equivalent of his or her manual signature on the said form and certificate. So now we go to tax amnesty. If you remember, on February 4, 2019, the Tax Amnesty Act or RA 11213 was approved and signed into law by the President, which grants amnesty on all unpaid internal revenue taxes imposed by the national government for the taxable year 2017 and all the prior years with respect thereto, and all other internal revenue taxes and tax on delinquencies, with the main objective of granting taxpayers an opportunity to settle their outstanding liabilities with the view of providing the government additional funding and revenues to support its projects. So we find the legal basis of this tax amnesty extension under Revenue Regulations 4-2019 in relation to Revenue Regulations 32-2020. So who are covered by the said tax amnesty? Under Section 3 as amended, all persons, whether natural or juridical, with internal revenue tax liabilities covering taxable year 2017 and prior years may avail of tax amnesty on delinquencies within 1 year from the effectivity of these regulations or until June 30, 2021. So originally, it was just until 2020. So by the issuance of this revenue regulations, they extended the availment to June 30, 2021 as a provision for the taxpayers who were not able to claim for such amnesty because of the logistical constraints brought about by COVID-19. So for the delinquents account, it's actually 40% of the basic tax assessed. For those with pending criminal cases for tax evasion, you can settle that for 60% of the basic tax assessed. For those with final and executory judgment before the effectivity of these regulations, you can settle those in the amount of 50% of the basic tax assessed. For withholding tax liabilities of withholding agents arising from failure to remit and remit withheld taxes, you can settle the same for 100% of the basic tax assessed. So as I said, due to COVID restrictions, taxpayers are left with short period of time to take advantage of the same amnesty law on delinquency, since the BIR or the legislators have extended the availment of the same, which is very rare for the BIR to issue extensions. So what are the effects if the following amnesty on delinquencies is availed by the taxpayer? Number one, of course, the delinquencies shall be considered settled. Your tax delinquencies will be closed under the account of the BIR. Number two, the criminal cases under Section 18C and its corresponding civil and administrative cases shall be immediately terminated by virtue of the payment of the amnesty amount. Number three, the taxpayer shall be immune from suits in relation to such delinquencies. So the BIR cannot go after you for delinquencies for the period which you availed of the tax amnesties. Note that under the regulations, there are actually three requirements for this one to apply. First one, if the BIR has issued a notice of levy or attachment or garnishment against the taxpayer, you have to acquire a lifting of the notice from the BIR, and you have to obtain from them the authority to cancel assessment within 15 days from the acceptance of payment form and delinquency return. Or if you cannot obtain the original copy of the same within 15 days, duplicate copies stamped received by the BIR of the acceptance of payment form and the delinquency return would do to avail of the immunity from BIR audits in relation to the taxable year in which you applied for the tax amnesty. So second to the last discussion that we will be having for this afternoon is the related party transactions. I will be sharing updates on transfer pricing documentations because I know that it's a vital part of this year's compliance requirements. So we find the legal basis under Revenue Regulations 2-13, Revenue Regulations 34-20, Revenue Memorandum Circular 76-20, and the most recent issuance with regard to related party transactions, related Revenue Regulations number 19-2020. Well, previously, the PIR required all companies to comply with the transfer pricing documentations in the BIR form 1709. But because of the noise that the business community had made and the clamor of small businesses and small and medium business enterprises, the BIR has actually listened to the people and released a regulation limiting the required companies who must submit BIR form 1709 and transfer pricing documentations. So when does the RPT BIR form 1709 apply? It applies to cross-border transactions between associated enterprises. It also applies to domestic transactions between associated enterprises. So under the updated regulations, who now are required to file for BIR form 1709? First one, those classified as large taxpayers. So as long as you are classified as large taxpayers, you have to automatically comply with the filing of BIR form 1709. Number two, taxpayers enjoying tax incentives. For example, Board of Investments, registered and economic zone enterprises, those enjoying income tax holiday or subject to preferential income tax law. So basically, these are the companies registered with PEZA or BOI, and those enjoying income tax incentives such as the preferential rate of 5%. Number three, taxpayers reporting net operating losses for the current taxable year and the immediately preceding two consecutive taxable years. So it's pretty straightforward if you are reporting in net NOLCO for the current taxable year, and for the third consecutive taxable year, you have to file for a BIR Form 1709. Lastly, a related party as defined under Section 3 of Revenue Regulations 19-2020, which has transactions with the aforementioned entities. So one of the developments here is that key management personnel are actually not required anymore to submit Form 1709. Only those listed in this classification rather, are required to file for the same. So now what happens to those who are not required to file for BIR Form 1709? Well, it's worthy to note that those who are not required to submit the BIR Form 1709 must disclose in their notes to their financial statements that they are not covered by the requirements, and the procedures for related party transactions under RR 34-2020. So if you're not covered, you just disclose it through your financial statements or your AFS that you are not covered by the requirements under the regulations. You don't have to notify the BIR of the same. As long as you disclose it in your FS, that would be sufficient under the law. So how should this be filed? For manual and EFPS filers, they must file it manually with the large taxpayers or RDO where the TP is registered. But recently, the BIR has issued a circular to the effect that you can file the BIR Form 1709 through EAFS facility. Another tip that I can give in filing a 1709 form is that when you submit the form, you have to attach a copy of your ITR, because some RDOs aren't actually aware that they are supposed to receive such. Aside from the ITR, you must bring a copy of RMC 76-2020 and specifically point to the RDO question number 7, which to the effect discusses that RDOs are required to receive Form 1709. So what are the changes under the new regulations for related party transactions? Number one, the enumeration of related party transactions involving foreign and domestic related parties with their respective amounts and taxes withheld is hereby omitted under the new regulations. So the focus is on related parties who are your related parties. Now it's geared towards the disclosure of related party transactions. As can be seen in this second item, as I said, the new version is geared towards the disclosure of related party transactions per transaction type and not per related party alone. So they shifted from related parties to transaction type. today, the details of the related parties transactions are categorized into the sale of goods and provisions of services, purchase of goods and services except those provided by key management personnel, loans granted to or non-trade receivables from related parties, and other related party transactions. So before as you can see here, they focused on the entities rather than the transactions. Now they're focusing on the transactions rather than the entities. So another change in the RPT reporting is that under the old law, all related party transactions are required to be disclosed. But with the new regulations, they specifically exclude the disclosure of compensation to key management personnel, the dividends and branch profit remittances. It's a welcome development for KMPs, the exclusion of KMPs compensation, because a majority, prior to this, majority of KMPs, not all, are not willing to divulge or disclose how much they're earning from from the company they're related with. So it's a good thing that they finally excluded the disclosure of the same. For the next one, with regard to the sworn declaration, it's basically the same. Number one, the sworn declaration must have a provision indicating that the BIR Form 1709 was prepared by the taxpayer in good faith, that it was accomplished truthfully and correctly, and that the taxpayer consents to process the information under the Data Privacy Act. What the new regulations inserted is the third one, the availability of required attachments during the audit. So this is BIR just wanted to make sure that all the transfer pricing documentations will be made available to them upon full audit of all internal revenues of the company. Lastly, with regard to the signatory, now it's not required to be signed by the president, principal officer, treasurer, or assistant treasurer. It can be signed by either the taxpayer, president, principal officer, or authorized representative. Now, for the transfer pricing documentation threshold, or what we call in practice materiality threshold, the previous discussions, the previous slides that I presented, was for the BIR Form 1709 requirements. Now, if you meet one of those four classifications I mentioned earlier, automatically you would have to file and submit a BIR Form 1709. That's very clear. In this section of my discussion, I will explain the materiality threshold, wherein if you meet the following threshold, aside from the BIR Form 1709, you will also have to submit the transfer pricing documentations along with the BIR Form 1709. So as you can see, both thresholds are independent of each other. Under the first threshold, it's actually twofold, and it's joined by an end. So you have to meet both of them. So annual gross sales or revenue for the subject taxable period exceeding 150 million pesos, and the total related party transactions with foreign and domestic related parties exceed 90 million pesos. So if you have a taxable as a gross sale of 150 for the current taxable year, and your related party transactions exceed 90 million pesos, you're automatically required to submit the transfer pricing documentations along with the BIR Form 1709. For the second threshold, the aggregate amount of the RPTs involving sale of tangible goods exceeding 60 million, or service transactions, payment of interest, utilization of intangible goods, or other related party transactions exceeding 15 million. So if you reach the following threshold, you'd have to submit also your transfer pricing documentation. It's either or, so it depends on what transactions you have undertaken with your related party. If it's a sale, there's an aggregate amount of 60 million. If it's service or other transactions such as interest, payment of interest, utilization of intangible goods, or other RPTs, the threshold is 15 million pesos. So for the last part of my presentation, the revised audit procedures. We find the basis in RMC 110-20. Because previously, the modes of service that was issued under several regulations was for the notice of assessment, and regulations did not discuss any notice or any service of letters of authority. So with the issuance of RMC 110-20, the BIR made it clear that the following are the modes of service of letter of authority. So for the first one, by personal service, by delivering a copy of the ELA, or the electronic letter of authority, at the registered or known address of the taxpayer, or wherever the taxpayer may be found. And it can be also served by substituted service if personal service cannot be made. So how do you effect a substituted service? First, may be left at the taxpayer's registered address with his clerk or person having charge thereof, of personal or legal age. Number two, through a barangay official when there is no person is found in the registered address, or the taxpayer refuses to receive the electronic letter of authority. Thirdly is through mail, by registered mail with return to sender after 10 days, or through reputable courier services. Number three, ordinary mail if no registry is available. Now, what is the relevance of this to the audit due process? So, as stated in Medicard versus Commissioner of Internal Revenue, a letter of authority is the authority given to the appropriate revenue officer assigned to perform assessment functions. It empowers or enables the revenue officer to examine books of account and other accounting tax records of the taxpayer for the purpose of collecting the correct tax amount. So the court also discussed that there must be a grant of authority before any revenue officer can conduct an examination or assessment. Equally important is that the revenue officer so authorized must not go beyond the authority given. In the absence of such authority, the assessment or examination is a nullity. So the relevance is that if you don't follow the aforementioned modes of service, if you don't follow it properly, if the BIR doesn't follow it religiously, you can have the tax assessment cancelled by virtue of the due process as discussed under the Medicard versus CIR ruling. Because from previous experience, some of our clients doesn't even know the proper service of letter of authority. They just receive it, even though they have no authority to actually receive it, and they just accept the assessment issued in the PAN or the FAN. By knowing the following modes of service, you can have a determination if the assessment notice has been issued in accordance with the due process rules ordained under the tax code and our constitution. Another change in the audit procedure can be found in RR 22-20, or the notice of informal conference versus notice of discrepancy. So under the old regulations, the BIR shall issue a notice of informal conference, informing the taxpayer of their findings, if they have any, and discrepancies in the course of their audit. Now, under RR 22-20, they actually just changed the name. Instead of NIC, they now name it as Notice of Discrepancy, which performs or functions similarly with Notice of Informal Conference. The only difference from the old Notice of Informal Conference is the day that the revenue officer must forward the report to the reviewing officer. So for the old regulations under the Notice of Informal Conference, the revenue officer has 7 days from the conclusion of the informal conference before he must endorse the case to the assessment division or reviewing department. In the NOD, the revenue officers have 10 days from the conclusion of the discussion before he must endorse the case to the reviewing authority. So what this does is it gives the BIR ample time to review, to examine, to scrutinize the books of account of the taxpayer so as to avert any errors in their computations, and so that they can assess properly the tax liabilities of the taxpayers. So we've reached the end of my presentation. I hope that you were intrigued, more so delighted to learn a few tax updates during the time of COVID. There are some of the items that I found relevant in today's time. It may not comprise of all the tax updates that were issued since last year because there are so many regulations and circulars, but at least the more important ones were discussed. So should you wish to consult any of your tax queries, we are more than willing and happy to discuss it to you through email or even a consultation through teleconference or phone. You may reach us through our contacts below for the same. Thank you very much.
Thank you so much, Attorney Kim, and of course to Attorney Veron as well. Now we will be opening the floor for our Q&A session. So earlier, we received questions. If I'm not mistaken, I think Attorney Veron was able to capture some of the questions. And we also have one question from the box right now. So with that, I'll just start with this question. So as per Rosny, he's asking on alternative working arrangements as to what's the impact if the start and end has not been reported to DOLE. I'll give the floor now to our speakers.
All right. Sorry, who?
Mr. Rosny in the Q&A.
Rosny. All right. Hi, Mr. Rosny. So to answer your question,
Sorry, it was Miss po pala. Miss.
although if you will not be able to report the alternative working arrangement. Can you hear me properly? All right. Okay, however, in some types of alternative work arrangement, like in the compressed work week, wherein the normal work hours is extended from 8 hours to 12 hours, reported to DOLE, then you may be liable to the employee for his or her overtime pay. And for the alternative work arrangement in the form of forced leave, if this will not be reported to DOLE, then you may be liable if the employee will raise this question soon for constructive dismissal. So as previously mentioned, even if there is no specific sanction, if ever you will not be able to report. So in some types of alternative work arrangements, there may be repercussions. And aside from that, in case there will be a labor audit, then you will be required nonetheless to report your alternative working arrangement. And in any case, the reporting is just through the submission of RKS Form 5 online to the DOLE report website. So aside from that, before we got disconnected, I saved a few questions, and one of which is for work from home arrangement. I just failed to get the name of the person who typed the question. I'm sorry for that. In any case, so here is her question. I think she's a she. So for work from home arrangement, should it be reported to the DOLE, even though the physical office is yet to be ready for occupancy since it's just new? So as previously mentioned, there's no specific sanction if you will not be reporting your alternative work arrangement. However, in case there will be a labor audit, then you may be required to report the same. In any case, the reporting is just through online submission of the RKS Form 5 to the DOLE's report page. So aside from that, there is the third question which I saved. It is so when can flexi holiday be applied? So as discussed in your a while ago, so there must be an agreement first between the employer and the employee covering the flexi holiday. So once there is already an agreement, this has to be reported to the DOLE report page through the RKS Form 5. Otherwise, it may be considered as diminution of benefits because a work performed during a holiday entails a holiday premium aside from the usual pay during the same. So, and the third one, the last one, which I saved, is forced leave legal? So yes, it is legal. So you'll just have to utilize the remaining leave credits of the employee. So if there is none, the no work, no pay scheme shall be followed. But of course, as previously mentioned, this type of alternative work arrangement has to be reported to the DOLE because otherwise it may be construed as a constructive dismissal. All right. So that's all that I gathered before we got disconnected. You have any more questions?
I think we have a new question for Attorney Cathy.
Okay.
So a question from Emily. So you mentioned in the submission of 1709, there were two documents. One was the ITR and a revenue memorandum. What number in there was the revenue memorandum? The revenue regulations pertaining to the submission of related Party Transaction Form 1709 was outlined in RR 19-2020. But if you're asking for the threshold, let me get back to you for the exact RMC issued by the BIR.
Another question that we have, I think, is that when and how can Flexi Holidays arrangement be applied?
Okay,
I think it
I
was
think yes, this was already answered a while ago. So just to reiterate, so there must be an agreement first before between the employer and the employee. So the application of the holidays to which the employee will choose will have to be indicated in the agreement, and this has to be reported to the DOLE report page through the RKS Form 5.
okay. Do we still
Yes.
have few
Yes.
more questions?
I just have a clarification to Emily. Just shoot a message so that I can reply the exact BIR issuance on the same matter that you asked a while ago. Thank you.
Okay. So do we have last questions from the participants? If we are PESA registered, would we need to file 1709?
Yes, as long as you qualify, you are qualified under the 4 classifications I discussed a while ago. All corporations that qualifies under that list or enumeration is required to file for BIR Form 1709.
Okay, I think that would be our last question. So if our participants still have more questions, please feel free to send us an email, which we will be leaving in the chat box right now. So that would be events@kittlesoncarpo.com. You can just message me and I will definitely direct you to our speakers. Okay, and we will also send out the presentation materials of our speakers. And if you have, if you would like to connect with us, feel free to do so. And we might also have a rerun just in case you may still be available or some of your colleagues would like to join. Please let them know as well. Okay, so thank you so much to our participants and of course to our speakers, Attorney Kim and Attorney Veronica. Thank you and have a
Thank you, everyone.
Thank you, everyone.
Thank you.
Goodbye. Stay safe.
Bye-bye.